Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today's video is the reason home prices are finally dropping, but not everywhere.
Right.
So what we're going to do is we're going to analyze the reason for the home price drop, which a lot of the reasons are obvious. And then we're going to go through the specific markets where they're dropping the most, and then the markets where they're increasing still. And this is going to surprise everybody when we go through these. This is brand new data. It just came out. Mm-hmm. Okay, so we're going to start with this. To put it in perspective, we're going to jump back to March of 2021. Mm-hmm. A woman in the DC area put her house on the market and got 88 bids, so 88 offers, including 76 all-cash offers and 15 for people who haven't bothered to visit the property in person. The offers just kept coming. She told CNN at the time, "I'm thinking this is just out of control." Okay, the last time, we've seen this a lot the last 2 years. Mm-hmm. The last time we saw this was probably 2000, maybe 10?
Right. So when real estate prices were down, there were a lot of multiple offers. It was not uncommon to get 50, 80 offers on a property. So the fact that this happened recently, there are echoes of the past, but this was a little bit different.
Okay, our record is 125. Okay, that is our personal record.
We're not proud. Okay,
we're not proud. It took 3,000 home sales of representing listings to get that many. I think the next one after that probably was like 80 or less. Okay. What's interesting was that home prices in the United States fell by 1.1% between July and August, according to data from Case-Shiller. Now, it may not sound like a lot, but on average for the U.S., it's a lot, because then if you average that out, that's almost like 12 to 13% for the year, mm-hmm. if it happens every month. It's actually the biggest decline since the bottom of the market in 2012. Now, remember, that housing collapse took 6 years from 2006, top of the market.
Okay, when you're saying the biggest decline, you're talking the biggest month-over-month decline.
It's the biggest month-over-month decline since before 2012. Right. So since 2012, last 10 years, mm-hmm. it's the largest monthly decline. Mm-hmm. Okay, now, when these companies gather data, they're gathering aggregate national data, like the U.S. is one big market.
Correct.
Okay. And when the people are watching the other videos where they're focusing on just super negative data, right? Because it's clickbaity and they get a lot of views, right? Mm-hmm. They're focused, they pick the worst markets. Like the biggest amount, like they'll just talk about how inventory, like one aspect, inventory in one market, Boise, has spiked. And then they just run all these crazy videos on it. And then they try to equate that to the whole country.
Right. I mean, look, I understand. It's entertainment, okay? It's drama, it's entertainment. Yeah. So that's fine. We're not here to entertain you. We're here to bring you information. Moving on.
Okay. So how long, okay, first of all, 1.1%, but we already said that there's some markets that have been increasing.
Right. And, it's interesting because it's not the markets that had the dramatic increases in the recent past, but it is markets that have generally done well. Okay.
So what we're going to do is, before we run into those specific markets, we're going to put up this slide here. The title of it's "The Post-COVID Housing Boom is Over." These are changes in home prices since January 2020. Now, it looks super dramatic, mm-hmm. but this is not absolute prices. This is percent increase. So the reason that there are two different indexes, Case-Shiller and Zillow index, okay? And now, of course, Zillow is mainly going to look at resales. Case-Shiller is going to take in a bunch of other data. So not saying which one's more accurate. But if you look at the increase, the percentages are on the left. We basically had over 40% increase. The Zillow indexes prices have flattened out. The Case-Shiller does show them declining. It looks like the Zillow one lags a little bit, so it'll probably start showing a decline pretty soon. But what we normally see, how much normally wanted do we see year over year increase if we look back over the last 30 years?
So we're looking at somewhere around 4%, 5%.
Okay, 4 or 5%.
Yeah.
So we should have seen 8, 10% appreciation the last 2 years.
Right.
But we've had 40. So obviously the market's going to start making its way back to where the long run of home price appreciation would have been. However, there's a couple of factors that are playing in the favor of them not maybe going all the way back down, because they would have to fall pretty far.
Right. So there are a lot of different things going on. We've talked about this before. We've got this huge generation of people that are coming into their own. They're making more money at this point in their lives than any previous generation has made at the same point in their lives. So they are out there buying homes. We do have a housing shortage. We have.
And when you say housing shortage, it's not numbers of houses for sale. It's total stock of houses.
Right.
We have to point this out every video, because when you say that and people go, no, the housing, there's no shortage. There's more houses.
Right.
Yeah.
Right. So what we're talking about is overall housing stock.
Okay.
Because when we're talking about your particular market, somebody's selling in your market and they're buying in another market, or they're buying in the same market. So you're kind of trading across the board. But if you're looking at the whole U.S. market, then that's where you're realizing that if everybody who was willing and able to buy a house was to buy a house, there would not be enough houses to go around.
Okay. When we compare the housing market, because the stock market looked a lot like this, but then it started really coming down substantially. The reason why the stock market came down is because the fundamentals that people invested on, which is this thing called price to earnings ratio. It's like, what's a company worth? Like, how many years of earnings, multiplied should be the market capitalization of a stock. And those multiples got way out of bounds for what is normal in the stock market. It got overbought. And so fundamentally, the stock market was not going to trade at like 24 times earnings forever, right?
Right. And part of the reason for that was because people had really nowhere else to put their money, because remember, money was virtually free, right? So because the cost of capital was so low, people were trying to allocate their capital anywhere where they could earn anything on their money. So that was why everybody shoved their money in the stock market. Okay.
Housing, though, has a different problem. Housing is fundamentally strong. Like, it has strong fundamentals. There wasn't a ton of houses built. There's if anything, there's even less and less houses being built right now. The numbers made sense from a return point of view. A lot of people moved. All these other things, call it the new meta or the new normal, where people wanted a bigger house or people wanted to work from home, so they left the cities, they went to the suburbs where they bought houses. They basically left apartments and moved into houses.
But then they also left, I think the thing that maybe we should discuss is that people in particular markets that were in a particular industry left those areas because they could work remotely. And they have resisted going back to work in an office environment. And what I'm talking about are the tech workers.
Okay.
So,
and we're going to see that when we show you the places where home prices have fallen the most and where they're climbing still.
Okay.
I think we're going to go through that. We'll talk about that, because that's definitely one of the interesting things that happened, because we definitely have had more volatility in the last 2 years than in the last decade. When the last decade was actually pretty even. The housing appreciated at 4.8% like almost every single year.
Right.
Even though people in 2019 kept screaming, it's overbought, these prices can't be sustained, don't buy yet, wait until houses fall, and then they just kept going up. And a lot of people now are like, they're stuck, because they really are like, well, I could have bought 5 years ago, 3 years ago, but now I can't because it's crazy. Okay.
Right.
But really the problem with housing is one huge thing.
Okay.
It's interest rates.
Right.
It's choked off like a ton of buyers.
It has. It's priced a lot of people out of the housing market, and that was kind of the intention of the Fed. The Fed used the big hammer, so to speak, to put the brakes on housing. Now, they did the same thing back between 2004 and 2006, and we know how that ended up, which was something that I've mentioned in previous videos. My concern with the Fed raising interest rates is that they are raising them quickly, and housing takes a while to catch up to all this. And by the time it does, then the Fed has kind of maybe overshot the mark.
Right.
And that's what happened the last time. That was part of a contributing factor of what happened the last time. So my concern is that the Fed is going to raise interest rates above where they need to be, and then housing will continue to decline even when the Fed stops raising interest rates because they've gone too far.
Okay, we're going to put up the fun chart. This is the chart you've been waiting the entire video for. Some of you probably may have skipped ahead just to see the chart. Okay, so these are the top 10 biggest declines and biggest increases in the top 50 markets just since May of this year. Mm-hmm. So this is right now the very end of October. Okay. So over on the left-hand side, those are all in red. Those are the declines. And some of those are pretty substantial just since May. Mm-hmm. But then if you go over on the right, you see markets that have increased. So we'll notice that it says at the top, a Florida boom and a California bust. You have a lot of these: San Jose, San Francisco, LA, San Diego, Sacramento. You also have Portland, and then Salt Lake City, which is surprising here, but they had a huge run-up. Mm-hmm. Okay. What do these have in common? Because some of these were markets people fled to.
Well, you mean that they fled from the ones that are decreasing?
No, like people left LA and went to San Diego, or
I see what you're saying.
They left San Francisco, went to Austin, but now Austin's down 8%.
Right.
But what's kind of this common theme?
So I think part of it is, what I was alluding to earlier, is that you've got a lot of tech workers.
Okay, tech workers.
So these tech workers, they decide that they would leave more expensive areas and move elsewhere. I mean, some we've talked about this before. They've moved, to the middle of the country maybe, or they move closer to family or wherever. But out of those areas, because now they could work remotely because of COVID, and then once COVID was over, they have resisted going back to working in an office environment because they're happy where they are. And I think it'll be interesting to see, as kind of tangentially, what's happening with these tech companies as they are getting a little slimmer, a little more cost effective. And part of that is downsizing as far as their workforce. It'll be interesting to see which ones get cut and which ones don't. Are these people who have relocated permanently outside the geographic area of where the company is located? Are they going to be the ones on the chopping block? Or are those people going to be able to withstand maybe a pay cut? And will they be kept, as opposed to people who have stayed locally and are a higher cost to the employer? It'll be interesting to see how that actually shakes out.
The one that really stands out to me is San Francisco, about minus 8%. And this is why. Because from the beginning of the pandemic until now, when everything else was going crazy in the country, prices were declining. Mm-hmm. Like it was pretty bad there. Prices were declining, houses were vacant, people were having a hard time renting. Apartments that used to have a waiting list to get in were offering, like, people, they would say, you get 2 free months of rent if you'll just renew for another year, right?
Right.
And I read a thing where somebody had said that the apartment building they're in, they had it was like an 80-unit building, and they had like 24 vacant units that they couldn't fill. But here's the thing: is San Francisco's down another 8%, and I think there's an opportunity, because I think at some point San Francisco will probably make some kind of comeback, mm-hmm. Because there is a lot of wealth in the Bay Area, and I think that there's potentially some deals there. If you want to have some fun, go get Realtor.com, get the app. Or Zillow app, whatever, and go look in the San Francisco area. It might work better with the Zillow app, and go look at different parts of downtown San Francisco, Mission District, and those areas, and find a house that's listed, and then go back and look at the price, like what the Zestimate was 2 years ago. It has a little chart. It shows you the thing, and it shows the values going up, and then starting in 2000, they start declining. Because I found places that were substantially cheaper, like they were $2 million a couple years ago, and they're $1 million. And we're talking 2-story, 2,400 square foot, 4-bedroom Victorian in a decent area for $1 million, which right. is unheard of. So it still may not make sense from a cash flow perspective, like what you could buy it for, because interest rates are really high. But
right.
But I think this is. I know there are definitely some markets that I would run down with a bunch of money and buy some houses if that same thing happened.
Right. The issue with San Francisco, I think San Francisco is kind of a unique duck because San Francisco has some structural issues within the city. It's a small city.
It's super small. People don't realize how
Right.
small it
It's a
is.
very small city, and it has some structural issues as far as the way the city's managed and services and their unhoused population and that sort of thing. So I think that's part of what's happening with San Francisco
Okay.
is people have had the opportunity to move out, and they really that was one of the reasons why they left the city
Right.
is that they just got to a point where it was just untenable to be walking down the street and feel unsafe in almost every neighborhood.
Other interesting thing is Austin down because remember Austin had one of the biggest. It was the second or first behind Miami for run up. What happens? A lot of tech workers got down there and then either got laid off or decided they would work remote, so they went to other places where they could get a place cheaper and work remote from there. And I think that right column when you see those Florida places, Orlando, Miami, Jacksonville, Virginia, very interesting, Richmond, Virginia Beach, even Oklahoma City, Memphis, Indianapolis, Birmingham, Alabama, Louisville, Kentucky. Those are decent sized population. Those are not, like you may not think that Memphis is a ton of people, but it's a lot of people. So is Indianapolis. It's a huge metro area.
Right, but see, what those areas also have in common is that the Florida places are places that have always been attractive. Florida has almost always done really well.
Right.
But the other places, they do have a well-educated population. Their tech industries are growing. So you've got these people from tech areas along the West Coast that have migrated to those areas, and that's part of what's spurred on their growth and their rise in prices.
It used to be if you work for a tech company, you worked in this one city that the tech company was in. It's a relatively recent phenomenon to have a tech company and then it also have offices in other places. We're just talking about tech companies because you needed everybody in one location, but because you didn't have, internets and things like that where you could have a distributed team. This is just going to increase, and I think it's going to, in real estate, as far as real estate's concerned, it's going to, I think markets that are, less expensive, but they still have, like if you've ever been to Miami, it's pretty fun. There's stuff to do there. Like it's not a terrible place and it's not perfect by any means, but Miami's way better than San Francisco. Like I know people that have taken their companies there and said, I spent 20 years in San Francisco, I'm never going back. And I think some of these other places, people get there and realize it's pretty nice.
Right. I mean, I'm a lover of San Francisco. I've spent a lot of time there and I've really enjoyed the city. But I have to agree with you. Miami has a lot of good points. I'm rather fond of the beach and of the weather. And Miami is a young city. That's the other thing, because it's attracted a lot of tech workers, which tend to be on the younger side. So there are a lot of fun things to do, lots of great restaurants. And Miami, I think, is more spread out than San Francisco. So I think there are a lot more opportunities there, not only in tech, but in other areas. And I think there's more, there's a certain rebirth to Miami, I think, that's taken place, particularly with the new political climate there, as far as really paying attention to companies and to industries and encouraging them to relocate to the Miami area and giving them incentives. I think that makes a huge difference.
The other thing potentially that is happening in some of these other markets, when you look at the, Oklahoma City maybe or Indianapolis, I don't know, there are still companies, hedge funds, et cetera, with cash still buying. They haven't stopped. And they're going to keep buying if in cities they find deals. Some of these markets, now notice Las Vegas isn't on the chopping block yet. We didn't show up on here. But there will be markets where they can come back in and start buying again. They're very data-driven, these companies. They look at the data and it tells them where to do it. They don't make an emotional decision. They understand what's happening with rents, with populations, with building, and these like BlackRock and these companies, they have a huge number of people who are called analysts. And all they do is they try to find the signal in a bunch of noise. And then they say, hey, this is the opportunity to do this. And it's all backed up with data.
Right. They are very data driven. And one of the things that we've talked about that they're looking at is opportunities for growth in those areas. So they are buying in areas that are growing. So areas that have grown, they might give those areas a break and seek out new areas that are positioned for future growth.
Okay, this is something fun we wanted to share with you. We're going to keep an eye on this. Obviously, as the market is changing, it's changing pretty dramatically. But there's potentially more volatility coming, and there could be more upside and more downside in the coming months. Depending on what happens with inflations, with interest rates, and then with the amount of inventory in specific markets. So we're going to continue to, as we get information like this, analyze it, basically talk about it. And then also information about Las Vegas and talk about it. Because we know there's a lot of people out there that are like maybe chomping at the bit to do something, but they don't want to. They're not really sure, right? Because you're being told don't ever buy anything in Vegas; it's overbought, and then you're being told you should buy now, and right, you just don't know what to do.
Right. So
and we're not telling you to do either. We're not telling you to sell your houses, buy your houses, or do anything. We're just saying that there's potentially opportunity in all of this somewhere.
Right. So there is opportunity, but like we've always said, everybody's situation is very specific, very particular. So look at what makes sense for you, crunch the numbers, and act accordingly.
All right. If you enjoy our channel, please subscribe to it, hit the notification bell, leave us a comment, share the video.
Absolutely.
Yep.
And tell us what you think about these markets that are both on the upside and the downside, and what are you seeing in your market? And be really specific. Tell us where you are and what's happening so we can get a better understanding. And that will help everybody else on the channel too, because they'll read your comments.
Cool.
All right. See you on the next video. Bye.
Bye.